Thank you for having me. And I think I'm the only person in this room without a CFA. And that's kind of funny because I've been giving talks to the CFA group and I've given the keynote to the CFA annual seminar here in the US for 30 years. And I've never had the desire to get a CFA. I mean, don't get me wrong. I'm not discounting the use of a CFA. But I don't want to go through that endurance test, which is what a CFA has become. What was the passing rate last year, like 23% or something in the middle of COVID. So what I'd like to talk about is valuation. Now, I know in your CFA, you've spent a lot of time reading about valuation, writing about valuation. But I'll be quite honest, I think we've completely lost our way in valuation. I mean, I start with a contradiction, and I'll tell you what the contradiction is. In 1981, I valued my first company. It was 40 years ago. And I still remember what I used to value the company. I wrote to the company for an annual report. I wrote to the company. I actually emailed a letter. I mean, I forget about email. I actually wrote a letter to the company saying, could you please send me an annual report? The company was very responsive. 10 days later, I got the annual report in the mail. And I value the company using a calculator and a ledger sheet. Most of you are too young to even know what a ledger sheet is, but a ledger sheet is just a blank sheet of paper with the lines already pre-drawn through it. And with a pencil, I forgot to mention that. Always a pencil, never a pen. And when you value companies with a ledger sheet and a calculator, the number of line items you have in your valuation are naturally limited because every single number has to be computed by hand. Now, 40 years later, think of what we have instead. If you want data on a company, you can find the data online. You can find the data on comparable companies. Data is incredibly accessible. And think of the tools you have today. You're no longer constrained by a calculator. Not only do you have tools like Excel, but there are people who've gone additional levels and have Python and artificial intelligence all feeding into the process. So if I paused right there and said, is this good news or bad news for valuation, that we have far more data than we used to have, and far more powerful tools than we used to have? Your answer is, of course, it's better for valuations. Valuations today must be better than the valuations 40 years ago. I wish that were true. I wish that were true. Because I think the quality of valuations is not only down, it declines every year. The more data you feed in, the more powerful your tools, the worse valuations are becoming. So I want to talk a little bit first about the philosophical reasons why I think valuation has lost its way, and then come directly to valuing young companies, which is where I think valuation completely has lost its way. People have no idea what to do. So let me get the show on the road. Let me start first by drawing a contrast between two words that we use interchangeably that we should not. The words are value and price. We know what drives the value of an asset. We've known for hundreds of years. The value of an asset is driven by cash flows, growth, and risk. That's it. The Venetian glassmaker who sold his business in the 1400s valued his business based on cash flows, growth, and risk. Now, of course, in the last 100 years, we've added structure to this process. We've added tools and measures. A discounted cash flow valuation might have shown up for the first time when John Williams wrote about 1937, but that doesn't mean that people didn't value companies before 1937. The value of a business is driven by cash flows, growth, and risk. And I'll wager much of what you do in your CFA is built around how do we come up with cash flows? How do we adjust for risk? How do we bring in growth? That's the value of an asset. Many of you, if I asked you whether you work in valuation, would say yes. Gus, for instance, mentioned that he's in the business of valuing young companies. That is not true. 95% of you are not in the business of valuing companies. You're in the business of pricing companies. You're saying, what's the difference? The price of an asset is driven by demand and supply. That's it, demand and supply. You're saying, aren't demand and supply driven by cash flows, growth, and risk? They might be. But think of all the other forces that come into play in demand and supply. Like what? Mood, momentum, revenge. Remember that when GameStop had that rise in price at the start of this year when those Reddit investors got together, you know what was motivating their pushing up the price? It wasn't that they thought that GameStop was worth a lot more than the market was pricing it at, but because they wanted revenge against the hedge funds. You think that makes no sense? It doesn't have to. There's an entire area of finance that's been built around why price is going to be different from value. It's called behavioral finance. Remember, all of behavioral finance does nothing to value. The value of a company is unaffected by every single paper in behavioral finance. Behavioral finance is all about why price can be different from value. Most of your jobs are pricing jobs. What does that mean? You got to come up with the right price for a company, the right price for an asset. And to price an asset, you know what you need to do? Forget about cash flows, growth, and risk. Who cares? It's what other people are paying for similar assets. I know it's called the market approach and the compare. If you use a PE ratio in 15 other companies, for God's sake, stop using the word value for what you've done. You price the company. If you're pricing a young company based on number of users, stop using the word value for what you've done. It's a pricing. I'm not saying one is better than the other, but that they're different games. So the first thing I would strongly recommend each of you do when you look at your next job is ask yourself, am I being asked to price this company or value the company? Because the tools you bring out of the toolbox have to reflect that mission. With that in place, let's step back from spreadsheets. I mean, for too many valuations, I think we've become Excel spreadsheet driven. When I sit down to value a company, there are 4 fundamental questions I need to answer about the company. It doesn't matter what kind of company it is. The first question is, what are the cash flows I get from this company from its existing investments, things it's already done, assets in place? That's why we usually start valuation, right? We go look at last year's financial statements. What does it tell you? It tells you what the existing investments of the company are delivering in terms of earnings and cash flows. What are your cash flows from existing investments? The second big question, and this is the question that makes people uncomfortable, and it should, it is what is the value that's going to be added or destroyed by future growth? Notice how I phrased that question. And ask you what your future growth is. Because left alone, that question gets the response you usually should get, which is, I want high growth. Growth by itself can add value, do nothing for value, or destroy for value. So the second question I would have about your companies, in your company, is growth adding value, destroying value, or doing nothing for value? And that requires assessing what the growth is going to be and how much you need to reinvest to get that growth. The third question I'm going to ask you is going to be a generic question. That's a common sense question. How risky are your cash flows? Notice the question I did not ask. I didn't ask you what your beta was or what your cost of capital. Don't mistake your tools for the end game. The end game here is you need to measure the risk and cash flows and bring them into value. With riskier cash flows being worth less, how risky are your cash flows? And then I'm going to ask you a final question that allows me to get closure in my valuation. I'm going to ask you when your company will become a mature company. You're saying, what's a mature company? A mature company is one that grows at a rate less than or equal to the growth rate of the economy. Why do I need to know? Because I can't estimate cash flows forever. And the only way I can stop estimating cash flows is by assuming that at some point in time, my cash flows will start to grow at a constant rate forever, because that allows me to use an infinite series in mathematics and get that most dangerous equation in valuation, the terminal value equation. What are your cash flows from existing assets? What's the value added or destroyed by future growth? How risky are these cash flows? When will the good times end? If I can answer those questions, I can value your company. Now, I've struggled with the way valuations have become incredibly complex over time. Many of you value companies with spreadsheets with hundreds of line items. And I'm not even sure how you read a valuation which runs through hundreds of line items. I prefer to keep my valuations parsimonious. In fact, I value almost every company I have to value with 6 inputs. 6, that's it, 6. I'll give you the 6 inputs. And these 6 inputs should allow you to encapsulate almost any company you have to value. Here's the first one. It captures the growth part of your business model. What expected revenue growth can I see in this company? Why revenue growth? Because it's the most honest measure of growth, right? Income growth I can get by cutting costs. Revenue growth, I either have to sell more or charge a higher price. Revenue growth. So if you're a small company in a big market, there might be lots of potential growth. If you're a big company in a mature market, not much to do here. The second question I'm going to ask you is going to be about the profitability part of your business model. Growth by itself can destroy me if I don't find a way to make money. Second part of the business model I ask you is, what's your target margin? Where do you think you're going to end up? Because in the near term, you might have all kinds of stories about why you have cost. But once this settles in, what kind of operating margins can I expect to see in your company? Now, again, if I left this question unmoored, you're going to say, I'd like a high margin, but you don't get to pick. And here's why. If you're a manufacturing company, your margins are going to be always smaller than if you're a software company. And the reason is simple. If you're a software company, selling the additional unit of software costs you absolutely nothing. Your margins can be 35, 40, or even 50%. If you're an automobile company, I don't care how great you are. When you sell another car, you've got to make the car. And that's going to make your margins come down to 6, 7, or 8%. Revenue growth margins. And there's a third leg that captures your entire business model. I want growth, but I also want growth to be delivered efficiently. My most generic measure of the efficiency of growth is to ask this question. For every dollar you invest, how many dollars of revenues do you get? It's called a sales to invested capital ratio. Excuse me. For those of you familiar with return on invested capital, replace the after-tax operating income with revenues, and it gives you a more generic measure, which you can use for any kind of company. Efficient companies deliver lots of revenues per dollar of capital invested. Inefficient companies deliver fewer dollars of revenues. Revenue growth, margin, sales to capital. I challenge you to find me a company where I cannot capture the business model for the company in those three inputs. Let's go below the line. There's risk, and risk has to show up as a higher required return. That required return we call the cost of capital, but there are two ways you can raise funding, equity and debt. The cost of debt is the rate at which you can at which you can borrow money long-term today. So it's going to be a function of your credit risk and your default risk. The cost of equity is much messier. It's what equity investors in your company demand as a rate of return for investing in your company. Say, how the heck am I going to answer that question when I have hundreds of different equity investors? In finance, we've come up with a very convenient solution, but that solution comes with a cost. The convenient solution is to say, look, rather than focus on all investors, I'm going to focus only on the marginal investors in my company. You're saying, who are the marginal investors? They're the investors who own a lot of shares and trade those shares. If you're a publicly traded company, those are likely to be institutional investors who are diversified. You're saying, so what? It changes the way you think about risk. Your cost of equity should reflect the portion of the risk that they cannot diversify away. And of course, then you can do the dance. Should I measure with the betas? Remember, the discussion of what kind of model to bring in comes in late in the game. And I'm completely agnostic. Find your own way of measuring that risk, and I can live with it, because ultimately I want a cost of equity, I want a cost of debt. They feed into a cost of capital. I discount my cash flows at the cost of capital. I've come up with my intrinsic value for the business. But before I get too excited, remember, this is my value for the business if it stays a going concern. You know what I mean by a going concern, right? If you have a bad year, you bounce back. You're saying, what's the big deal? Why can't I assume that? Well, you can most of the time until you cannot. Because sometimes you go down and you don't get up. You're out for the count. You fail as a company. You know that 2/3 of young companies don't make it to year 2. If you use a discounted cash flow valuation to value a young company, for God's sakes, tie up that last loose end, because if you don't, you're going to overvalue the company. And I capture that with a failure risk, the risk that your company will not make it. That's it. You give me those 6 inputs: revenue growth, margin, sales to invested capital, cost of equity, cost of debt, and failure risk. I can move the world. I can value just about any kind of company. Now, of course, you take what you've learned in the CFA and I give you a young company to value, you're completely lost. You know why? Because much of the CFA is built to value mature companies with lots of financial history. I'll be quite honest. If every company values a mature company with lots of financial history, you don't need a CFA. You give me a 10-year-old, forget about 10th grade. You give me a 10-year-old, a whole bag of candy in about 2 hours, and I can teach a 10-year-old enough discounted cash flow valuation to value mature companies that have lots of financial history. With young companies, here's what you need to be able to do. You need to understand that if all you have are numbers on a spreadsheet, you haven't valued a company, you just have an Excel spreadsheet. You need to also understand that if all you have is a big story for a company, which is what a lot of founders and VCs have, you don't have a value for a company, you just have a story. A good valuation, as I've often described it, is a bridge between stories and numbers. And with young companies in particular, this becomes critical because your valuation is being driven not by numbers. What numbers are you forecasting? There's no history here. The past financials tell you very little about the company. It's driven almost entirely by a story. This is the skill we've lost over the last 40 years as we become increasingly dependent on data and spreadsheets. We've lost the capacity to tell stories. And in fact, when you value young companies, that is really the skill that you need. You give me a person with an Excel spreadsheet, and an accountant should not be allowed near young companies. They're incapable. I know many of your accountants don't take it personally or take it personally. Frankly, I don't care. Accountants should be banned from valuing young companies. They don't have the mindset to do it because they're so caught up in computing ratios and looking at last year's financials that they've completely lost the script. With young companies, the story comes first. The numbers flow out of the story. Now, of course, as companies mature, you can become more of a number cruncher. If I gave you Coca-Cola or Kraft Heinz or Glaxo to value, hey, you can value it with an Excel spreadsheet by projecting out past numbers. But if I give you a young company to value, there is no way that you're going to be able to use a spreadsheet to value the company without a story tying your numbers together. As I said, this is the skill I think we've lost. And about 4 years ago, I decided to write a book that is perhaps my most, it's a book that probably deviates most from the script to what I usually write about. All of my valuation books have been about the mechanics of valuation, how to come up with cash flows, discount rates. So in 2017, I said, you know what, I'm going to write a book about how to connect stories to numbers. Because if you cannot connect stories to numbers, you cannot value young companies. And I came up with a 5-step process. And don't get too caught up in these steps. These are steps that work for me. You have to create your own way of connecting stories to numbers. You give me a company to value. The first step in this process for me is to tell a story about the company. Notice what I said. If I have to value a company, the first step is to tell a story, not open a spreadsheet and compute ratios. The second stop in this game is I've got to make sure the story I've told is not a fairy tale, that it's possible. And then I've got to go beyond that. I've got to ask, is it plausible and is it probable? I call this the 3P test: possible, plausible, probable. Third step in the process, I take the story I've told about the company and convert to numbers. And this is where having a parsimonious valuation model helps me. I take my story and say, what will this mean in terms of revenue growth? What will this mean in terms of margins? What will this mean in terms of reinvestment? What will it mean in terms of risk? And by the time I'm done, every part of my story is a number in my valuation. Step 4 does itself, because once I have those numbers, the rest of valuation is mechanical. I get a value for the company. I'm done, right? Not quite, because here's where step 5 comes in. When I'm done with the valuation, I'm going to be tempted to sit on and say, this is great. Pat myself on the back because it's my valuation. And that's where I've got to keep what I call the feedback loop open. Here's some advice for you. You value companies. Don't show your valuation to people who think just like you. In fact, don't show your valuation to other CFAs. You'll all pat yourself on the back because you all read the same stuff. You work off the same script. You think the same way. Show your valuation to somebody who's not in finance, not in valuation, and let them push back. Let them tell you you're wrong and don't get defensive. And basically what you're doing is you're listening to that feedback to make your story better. So rather than talk in abstractions, here's what I'm going to do. I'm going to take this process and apply it in a company. It's actually a company I valued about 2 months ago. maybe 2.5 months ago, called Zomato. Zomato is an Indian online food delivery company. It's just went public. And I was interested simply because people kept emailing me and said, what do you think about this company? It's going to go public. It's going to have a multi-billion-dollar valuation. And since I'd valued DoorDash already last year when it went public, I said, I'm going to try Zomato. So first step in the process is to tell a story for the company, right? Tell a story for Zomato. I've got to understand what the company does. I've got to understand the competition. I've got to understand the market. Zomato is an online food delivery company, just like DoorDash, but it's serving a very different market, the Indian food delivery market. And I don't know what its competition looks like. So the first thing I did when I wanted to value Zomato is I talked to people. Talked to people like I knew in India, and I said, do you order food online? And about 2/3 of them said, yeah, 1/3. I already got some sense of perspective because the older Indians I talked to were less likely to do this than younger Indians. But almost every young Indian I talked to said, I do order it. And then I said, why do you like Zomato versus, and they gave me a sense of the competition, what Zomato did well, what Zomato did badly. What I'm trying to say is often research today has become downloading numbers from a data service and computing ratios. Talk to people. Talk to people who use a company's products, talk to its competition, get a sense of the market. And the one group I would suggest you don't talk to is don't talk to the management of a company. In my 40 years of valuation, I've never once valued a company and talked to the management of the company to do my valuation for two reasons. One is I'm going to hear bullshit. Top management will spin you. They're like politicians. They'll spin. I'm not going to hear the truth. I'm going to know more about the company by talking to the guy in the mailroom than I would talking to the guy in the executive suite. The second is they'll put handcuffs on me in terms of how much I can use that information. You become beholden to top management if you let them supply you with the numbers, because now, if you look at the numbers and say, those numbers don't make sense, you're trapped. But talk to people who use the company's products so that you have a sense of what the company does. So I'll set the stage for Zomato. For those of you not familiar, Zomato is an online food delivery company. And if you think about the Uber business model that's become so common, an intermediary model, here's what Zomato does. It connects people who want food with people who have restaurants, and you can order the food and the food gets delivered. So you get your food, the restaurant gets your money. You're saying, how does Zomato benefit from it? They get to keep a slice of your order, and it's a pretty hefty slice. About 20 to 25% of your order amount goes to Zomato. That's their revenue. They also have some revenues from advertising where restaurants are allowed to put their names up on top. What I'm describing is actually a very common online model, right? A combination of transactions and advertising. They have a subscription model. So in fact, they're hitting every single angle here. They have a subscription model called Zomato Pro, where if you subscribe to it, you get special discounts and you get access to restaurants. And in recent years, they've actually even started a new service where they supply raw material, rice, flour, et cetera, to restaurants, where restaurants can buy from them. So they're clearly embedded in the restaurant space. And if you look at their financial statements, you see a couple of things. One is you see growth. Growth in what? In revenues. Now, if you look at the revenue growth over time, the total revenues have gone from 4.7 billion rupees to almost 20 billion rupees just in the last 4 years. So if you ask me, is the company growing? Absolutely. It's increased in size almost fivefold over the last 4 years. But here's the catch. Take a look at its operating income. The company is a money-losing machine. Already you can see the pieces in place for the modern IPO, right? The company is growing its revenues, but it's losing money. Now, one of the things you will notice is that those losses just continue all the way through. The losses start very early. Operating income is negative all the way down. It's a growing company that's losing money. I wasn't surprised at all when I saw this because there's a sense of deja vu. Pretty much every company that I valued for an IPO in the last 5 years has had growing revenues. And if you look at the operating income, it's a loss. Now, of course, the market it's serving is the Indian food delivery market. Now, normally when you value young growth companies in the US or Europe, it's a company that is growing. The market itself is pretty saturated. When you're valuing an Indian or a Chinese company, here's the challenge you face. You have a growing company in a growing market. Where's the growth in the market coming from? 1 billion people. Right now, if you look at the Indian food delivery market, it's tiny relative to the Chinese market. The Chinese online food delivery market is the largest in the world at about 90 billion. The Indian food delivery market is about 4.2 billion. And in the US, which, in 2020, there was a big jump, it's about 50 billion. So basically, if you compare across markets, the Indian food delivery market is really small. And from the perspective of valuing Zomato, this is really good news. You see why? Because you're saying, why would a small market be good news? Because the potential for growth is clearly much larger in India than it is in China or the US, because the market starts off at a low number. But there are lots of reasons, though, why the Indian food delivery market is so small. The first is per capita income. We forget that ordering food from a restaurant is discretionary. 70% of Indians are in no position to be ordering food from a restaurant because they're living day to day, hour to hour in villages beyond reach. So basically, you got per capita income being low, essentially translating into less online. And it shows up in the number of restaurants in India. So the first problem is per capita income is low. Second is, to order food online, you need a digital device. You can't just pick up the phone and order it online. You need, and the problem again is India is a far smaller smartphone penetration. It's higher than it was 10 years ago. It's been revolutionary, but it's still far lower than it is in the US or China. So first is per capita income. The second is digital access. And there's a third problem, which is cultural. I mean, I left India a long time ago, so I'm in no position to talk about the India that exists today. But the India I left, which was in the 1970s, I still remember I grew up in Chennai, which is in south of India, pretty large city. But the Chennai I grew up in had only 3 restaurants for a city with millions of people. You're saying, how come? Part of the reason is people didn't afford restaurants, but no, I was lucky enough to be born into a family that could afford things. But I remember my grandmother saying, why would you ever order food from a restaurant when you can hire a cook and get exactly the food you wanted at home? The notion of eating out was culturally almost a no-no. You didn't do it. Now, of course, that's changed at least partially, but no, I guess the Chinese are far more willing to order food online and always have been than Indians have. And that's the third big enter. So part of it is per capita income, part of it is digital access, and part of it is cultural. It's not as embedded into the Indian psyche to order food online. So my first big task in valuing Zomato was to make a judgment on what would happen to the Indian market over time. They're saying this is speculation. That is a word that infuriates me. What the heck does speculation even mean? That I'm making an estimate for the future? If you're not willing to do it, just leave the arena. Stop doing valuation if you view making estimates, making judgments as speculation. You're unsuited for the practice of valuation. Of course, it's estimation. I'm not God. I've got to make my best judgment. So the first step in the process, I estimated what the Indian food delivery market would look like 10 years out. Now, what will that depend on? Whether I like it or not. My story for Zomato is irretrievably tied to my story for India as a country, how India will grow over time, how Indian food culture will shift over time. And if you look at my potential markets, if India becomes more prosperous as a country, gets more digital access, and Indians start to order more like the Chinese, the food delivery market, which is 4 billion right now, could be as big as 40 billion. In my base case, I picked a number closer to 30 billion. I think 40 billion is stretching the limit. So in my story, I see the Indian food delivery market growing from 4 to 30 billion. You see why looking at Zomato's financials would have wasted your time? This is one of the most critical numbers that's going to drive Zomato's value. because the story I'm going to have to tell about Zomato will have to reflect what I think about the Indian market and what I think Zomato's place will be in the market. Now, let me emphasize, when we talk about stories and valuation, we're not talking about creative novels. Don't create characters who wander on and wander off for no reason at all. You want a valuation that's focused. Focused on the fact that every business has to make a profit, and simple. So I'm going to try to follow the advice and my own advice and give you my story. And I'm going to emphasize the word mine. It's my story. I know you might not like it, but tell your own story. I think of investing as personal. I have to tell my story. My decisions have been driven by my story. Zomato has a dominant market share of the Indian food delivery market right now. It's being challenged with Swiggy and Amazon Food, but it's a dominant. I am going to assume in my story that Zomato will stay dominant because this is a business with networking benefits. In other words, the larger you get, the easier it becomes to grow. So I'm going to assume they will maintain a dominant market share of this growing Indian market. That's half my story. That's going to give them the growth. But Zomato right now is losing money. In my story, I assume that once they get to steady state, they'll have the margins of an intermediary in the restaurant business. DoorDash's margins, the slice of the revenues that DoorDash gets to keep is about 20%. Zomato, I said, keeps 20 to 25%. Restaurants can afford to give up big slices of your order because they are sitting on fairly hefty gross margins. The cost of the food that you eat in a restaurant is actually about 20% of your restaurant bill. The rest is all the additional stuff. So they can afford to leave 25% on the table or 20% on the table. So I'm going to assume that Zomato's slice of those gross billings is going to stay at about 20 to 25%. Now there's talk about Zomato entering the grocery delivery business. I don't think that business, even if they enter it, is ever going to have the same kind of take rate. This is what the percentage of the gross billing that you keep as revenues is called the take rate in these businesses. The grocery business, you can't have a 20% take rate. Why? Because grocery companies don't operate with those kinds of margins. They can't afford to leave 20% with a company. So if Zomato enters the grocery delivery business, my story has to be with lower margins. Otherwise, I'm telling a fairy tale. I do think economies of scale will kick in as the company scales up and margins will improve over time. So I have a dominant market share of growing market, a take rate that stays where it is with this added grocery delivery business coming in with lower margins. And as this happens over time, I expect margins to improve to very healthy numbers. Now, of course, for the moment, I haven't given you actual numbers, but you've seen the story. But as I said, you got to stop and make sure the story you're telling is possible, plausible, and probable. I know it sounds like I'm playing on words. Lots of things are possible. A subset are plausible, and even smaller subset are probable. Whenever I listen to a story from a founder, I take them through the steps. First, I want to make sure the story they're telling is not a fairy tale. It's not an impossible story. Then I push to make sure it's not an implausible story. And I push even harder to make sure it's not an improbable story. I'll give you examples of impossible stories. About a third of the DCFs that I see from banks, consultants, appraisers are fairy tales. Nice looking numbers in a spreadsheet, but cannot happen. I'll give you a few examples. Now, I saw a valuation of a company and it was a valuation in British pounds, where the analyst had used a 6% growth rate in perpetuity for the company. If you do a valuation like that, please don't send that valuation to me unless you want to hear some very harsh words about what I think about very bad. You're saying, what's wrong with using a 6% growth rate? That's the average over the last 40 years. Because if your risk-free rate is 2% and inflation is 1.5%, and your economy is growing at 2.5%, putting in a 6% growth rate forever will be mathematically impossible. That is an impossible valuation. I saw a valuation done of a company where the analyst was projecting growth rate forever, but the revenues were going to stay stable. You're saying where the growth rate is coming from? Because they were going to cut costs. Okay, cutting costs is a way in which you can improve margins, but you can't cut costs forever because you know what's going to happen to your margin? It's going to hit 100% and keep going. I have never seen a company with a 350% margin, but that's what you're creating with an impossible company. It's amazing how common sense tests on your numbers can lead you to say, that's not going to happen. What's the difference with an implausible valuation? An implausible valuation can happen, but you better have a really good story. So an example of an implausible valuation is a company that has 20% margins in a sector where everybody else has 6%. I valued Severstal, Russian steel company, about 4 years ago. I gave them 20% margins. The steel business, a typical steel company, has 6% margins. Now, normally, if I tried to give you a company 20% margins and everybody else is making 6%, the question you're going to ask is, right, how come competition is not driving the margins down? You know what the answer for that with Severstal is? It's a Russian company. What outside steel company wants to go into Russia and compete head-to-head against Severstal? By being in a protected market, you're essentially ending up with margins much higher than the typical company in the sector. So implausible valuations, I'm going to push back and say, tell me why. And if you can tell me why, I'm going to walk away. And finally, of improbable valuations. I get sent about a DCF every 3 or 4 hours by somebody I don't know saying, can you just check over this DCF? In a moment of weakness, I often say yes. But here's what I'm going to check for if you ever send me a DCF. I'm going to check your growth assumptions. And I'm going to put it into 1 of 3 buckets: high growth, average growth, low growth. Then I'm going to check your reinvestment assumptions. You know what I mean by reinvestment? Your CapEx, your working capital. I'm going to put into 3 buckets: high reinvestment, average reinvestment, low reinvestment. Then I'm going to look at your cost of capital. The median cost of capital for a company in British pounds, right, at the start of 2021 was about 7%. 7%. If you're giving me 11% cost of capital for your company, you got a high cost of capital. You can do whatever dance you want and show me whatever beta you want, but 11% is higher than 7%. You're telling me in your story, your company is a risky company. So your cost of capital can be high, average, or low. And then I'm going to check. If you have high growth, you know what I expect to see? High reinvestment and high risk. And if that's not there, then I'm going to push back. And if you have a good reason for why your company can have high growth with low reinvestment and low risk, I'm going to walk away. Valuation is about challenging your assumptions from a common sense perspective. Looking to see whether your story is internally consistent and making sure that you're not falling for the story because you really want it to be true. Many of you might be familiar with the story of Theranos. Elizabeth Holmes drops out of college at the age of 19, creates a blood testing company. She claims she's going to revolutionize the business and make the world a better place. Who doesn't want a revolutionized blood testing business and making the world a better place? People bought in. And nobody asked the question. You know what the question is? Does your damn blood test work? And then 4 years later, we wake up and find that she'd been cooking the books and there was no real blood test. And of course, the entire company is kind of spun apart. There's a book on it. There's a movie on it. She's up for trial right now for committing fraud. But my point is, people didn't ask questions because they wanted the story to be true. I call these runaway stories. You know what the common feature of these runaway stories is? The people who tell these stories cloak themselves in goodness. I have only contempt for the ESG movement. I'll tell you up front. This is the most overhyped, oversold concept in the business. And I have some terrible things to say about ESG, but this is not the place I want to say them. But one of the reasons I absolutely despise this goodness cloak is it's being used by frauds and con men to cover up their frauds and cons. So check your story, making numbers. Since I only a couple of minutes and I want to answer some questions, let me summarize. So basically, once you've told your story, the story plays out in numbers. So whatever your story is, it's got a number that goes with it. That's where the craft of valuation comes in. In the case of Zomato, I took my story and made into numbers. So my story of a company with a dominant market share of a growing market in India with improving margins over time shows up as assumptions about revenue growth, assumptions about margin, assumptions about sales to capital, and assumptions about risk. I gave them a cost of capital roughly around the median cost of capital, actually initially higher than the median cost of capital in rupee terms for an Indian company, but over time moving towards the median. And the value that you will see me attach to Zomato reflects the story I've told. My point about stories and numbers is every number in that valuation, you point to that number and say, why is that number what it is? My response is always going to be with a story. That to me is a sign of somebody who's thought through their valuation, that they have a story behind every number and a number that's attached to every story. So when I finally ended up valuing the company, and my valuation, I usually present it in a way so you can see how every assumption comes from a part of the story. The value ended up with about 41 rupees. I did this the day before its IPO. You know what it opened at? 120 rupees per share. You know what it's trading at now? 140 rupees per share. A few weeks ago, I got a call from a journalist in India saying, Zomato is trading at 141 rupees. I noticed in your valuation, you valued at 41 rupees. How do you explain the 141 rupees? And I gave him my answer. I said, I didn't pay it. I don't feel the need to explain it. I've never felt the urge to go around explaining what other people pay. That's none of my business. I remember he also followed up and said, are you telling me the wrong? I said, no, I'm telling you nothing of the sort. I'm saying with my story and my numbers and my valuation, I wouldn't buy Zomato, but maybe they have a bigger story, a different valuation. It's hubris to claim that your story is the story and that everybody else is wrong. So think of valuation as telling stories, framing stories, connecting stories to numbers, and let go of this line item approach to valuation. Let go of financial modeling as being the answer to every valuation. Let go of your Excel spreadsheet. In fact, I would strongly suggest that you do at least one valuation with a blank sheet of paper and a calculator. It's amazing how sanity will return to the game when you have to think about a number and think about what am I assuming here? And always stop and ask yourself, are you creating a company that actually makes sense from a business standpoint? You can create some really amazing companies on spreadsheets. You can make margins 80%. You can make your revenues $1 trillion. Anything is feasible on a spreadsheet, but the world is not a spreadsheet. There are real world constraints you got to bring in, and that's got to become part of your story. So I'm going to stop there and open up to questions.